All right, let's just jump right into one of the biggest puzzles on Wall Street. Why is it that so many incredibly smart, hardworking people, maybe even you, try investing in the stock market and just end up losing money? Well, the answer isn't some secret formula or a hot stock tip. No, it's something way, way deeper than that.
This quote right here, this is the key that unlocks the whole thing. This one single idea from the legendary trader Jesse Livermore. It cuts right to the absolute heart of the matter. See, the stock market isn't just a game of numbers and spreadsheets. It's a game of human nature. And that, my friends, is where the real battle is won or lost.
So, if it's a psychological game, well, that explains a lot, doesn't it? It explains all that frustration. It explains how we can do all the homework, pick what looks like a fantastic company, and still get completely wiped out. So let's break down exactly why that happens.
And this really frames the problem perfectly, doesn't it? Our expectation is that investing is this clean, logical process. You analyze the numbers, you find that perfect stock, and you make money. Simple. But the reality, as investing legend Joel Greenblatt points out, is a totally messy emotional battlefield. The biggest challenge isn't finding the next big thing, it's just surviving your own worst instincts. And here are those instincts in all their glory. These are the behavioral traps that, as Greenblatt says, make us, practically hardwired from birth to be lousy investors. I mean, think about it. Our survival instincts, the ones that kept us alive on the savannah, are an absolute disaster in the stock market. We're wired to run from danger, so we panic and sell at the bottom. We're wired to follow the herd, so we get greedy and buy at the top. And of course, we're all wired to think we're just a little bit smarter than everyone else.
Okay, so we've established we're our worst enemy. The logical next step then is to just ignore our feelings and copy what the pros do, right? Easy enough. The problem is, when you look at the legends, they don't seem to agree on, anything. I mean, just look at this. On one side, you've got the value investing camp, guys like Joel Greenblatt. Their whole philosophy is to buy good businesses at a bargain price when everybody else is pessimistic. But then, on the complete other side of the universe, you've got growth investors like William J. O'Neill. They're buying the hot, explosive market leaders with massive growth, often when they're hitting brand new highs. One strategy is literally buying what's cheap and hated. The other is buying what's expensive and loved. They look like they're from different planets. So, this brings us to the most important question of all. If the absolute masters of the game have completely different strategies for picking winning stocks, then what on earth do they all agree on? What's the one thing they all have in common? What's the real secret here?
And the answer, it's pretty profound. It's the absolute core of what separates the pros from the amateurs, and it's the rule that nobody really talks about. Because frankly, it's not as sexy as finding that next stock that's going to go up 10 times in value.
Here it is. They focus less on being right and more on what happens when they're wrong. That's the whole point. Their genius isn't some magical ability to predict the future. It's their obsession with controlling the damage when they inevitably get it wrong. Their focus isn't on offense, it's on defense. That's the entire game.
So what does that actually look like? Well, it brings us to the first pillar of this unspoken rule. And it's a totally ruthless, non-negotiable discipline that every single one of the greats lives by. -8%. This number was William J. O'Neill's ironclad rule. If he bought a stock and it dropped 8% below what he paid for it, he sold it. Period. End of story, no questions asked, no hoping it would come back. The decision was automatic. It was his way of making sure that a small, manageable mistake could never ever turn into a catastrophic one.
And here's O'Neill himself explaining the why behind it. He said the whole secret isn't being right all the time. It's about losing the least amount possible when you're wrong. Think about it like baseball. It's not about hitting a home run every single time. It's about making sure your strikeouts don't cost you the game. You cut every loss short so you can live to play another day and let your big winners really, really run. So this is the key takeaway here. It's a discipline. It's not a suggestion. I love this quote from Jesse Livermore. He said, "When I see a danger signal, I don't argue with it, I get out." It's that simple. First, you define your exit, your maximum pain point, before you even buy. Second, the moment that alarm bell rings, you act. You get out. No hoping, no second guessing. And third, and this one's huge, you never, ever rationalize a bad trade by turning it into an involuntary long-term investment. But, having a mechanical sell rule, that's only half the battle.
There's a second principle, and honestly, it's probably the harder one. This one is purely psychological. It's all about having the strength to truly know yourself.
Just look at this timeline. This is the brutal, painful reality of sticking with any strategy that goes against the crowd. Joel Greenblatt's research found something incredible. Over a 10-year period, even the absolute best money managers, the top quarter, spent an average of 3 of those years performing in the bottom of the pack. I mean, just let that sink in. To be one of the best, you have to be willing to look like one of the worst for years at a time. The pressure to just give up and quit your strategy is absolutely immense.
And that brings us to the final hurdle. Let's call it psychological mastery. It's the ability to stick to your plan, to follow your rules, not just for cutting losses, but for sticking with your whole approach, especially when it feels terrible and it's not working. It's about having the guts to endure looking like a fool today so you can come out on top tomorrow. Jesse Livermore had the perfect name for someone who fails at this. He called them the involuntary investor. And we've all been there, right? This is the person who fails at both rules. They don't cut their loss when a trade goes south, and then they try to rationalize it by telling themselves, oh, well, I guess I'm a long-term investor in this company now. That little mental trick, that's exactly how small mistakes turn into portfolio-destroying disasters.
So when you put it all together, what's the big takeaway? It's this. It's not about the map, it's about the driver. The specific investment strategy you choose, value, growth, whatever, it's actually less important than your ability to execute it. Real long-term success comes down to 2 universal principles. Rule number 1, have a bulletproof risk management plan for when you're wrong. And rule number 2, develop the psychological discipline to actually follow that plan no matter what.
And that really forces us to ask one final tough question. We spend so much time and energy looking for an opponent on Wall Street, trying to outsmart the market. But what if the biggest, toughest opponent we'll ever face as an investor is the person staring back at us in the mirror? That is the unspoken rule of Wall Street.